I'm Sara Eisen here in Davos, Switzerland at the World Economic Forum, where the IMF has just lowered its outlook for the world economy to 3.5% growth instead of 3.7% it expected in October. I asked Managing Director Christine Lagarde about what she sees for the U.S. economy, which remains unchanged.
Well, first of all, there is no recession in the U.S., as we discussed, and our forecast is unchanged for this year and next. But the shutdown is clearly having an impact. I mean, beyond the fact that people who, operate from, one check to the other are hurt, and it's a sad situation, I have to say. But from an economic perspective, typically a shutdown of a very limited duration has a minimal impact on growth. You're talking about 0.01 or 0.02. That's the magnitude that we have been used to. But the longer it lasts, the more impact it has. And, when we do those assessment of shock to growth, whether it's on trade or whether it's on shutdown, you have the sort of direct impact. But then you have to add to that the confidence impact. And the more uncertainty and the longer it lasts, the more impact it will have from a confidence perspective. And people's, beginning to think, well, can't this be fixed? And how can policymakers arrive at solutions? And will that uncertainty actually impact the way in which we conduct business going forward? So that's where there is a potential risk.
There's also a risk that it's happening at a time where the positive effects of the tax cuts are starting to wane. The Federal Reserve has been tighter in terms of its policy. So there's a lot of things coming to the fore in 2019, adding up to a sort of uncertain outlook.
Well, we certainly forecast a decline in 2020 compared with 2019 to reflect exactly what you said. The fact that there is a limited direct impact of the tax reform, and the fact that clearly this prolonged shutdown is not a good thing. Now, in terms of the tightening by the Fed, what we understand, all of us, from the Jay Powell's comments and most recent press conference and considerations is that the tightening is not going to be as accelerated as we had initially anticipated. So it's good news, bad news. Good news because the cost of financing will not be increased as significantly as we had feared. Bad news because it means that he and his team are forecasting an economy that is not accelerating as much as had been anticipated. But the unemployment numbers are phenomenal.
There's also a lot of concern now that the balance sheet policies of the central bank, the unwind of the massive stimulus program, is starting to have a bigger effect on growth and certainly on the markets. Is that something that you guys agree with?
I would reserve judgment on that. I think it's early on in the process, and I would not, pass judgment.
But the new patient attitude is welcome for growth.
Absolutely. Well, it has to be data dependent anyway, and I'm sure that that's what the Fed abides by. And if they are moving or indicating that they will be moving at a slightly slower pace, it's probably that they are seeing numbers that are not very different from ours, which indicate, a slight slowdown going forward.
President Trump is not here, as you know. He was supposed to be. Theresa May, not here. She was supposed to be. Macron, who was here last year, not here. I mean, everyone's dealing with these domestic crises.
Yeah.
How do you see this impacting the outlook? And do you see it as part of the rise in populism?
It's certainly, from my perspective, looking at the economy, looking at numbers, looking at performance and forecast, we are seeing more and more of an impact by politics, by, in a way, non-financial, non-economic based considerations that have an impact on the economy. If it wasn't for what I just mentioned, which is essentially politics by nature, whether you look at Brexit or whether you look at some of the other threats on the horizon, it is politics. If it wasn't for those political components, the economy would be thriving even more.
So it's holding us back.
It's society adjusting to phenomenal changes that are happening at the moment, both at the geopolitical level, transformation of the geopolitical map, but it's also the technological breakthroughs that we are seeing everywhere, which require that we adopt a slightly different approach, where we focus on the people, where we make sure that they are equipped, that they can actually be able to adjust to this new economy.
And my final question has to do with rising debt levels. It's something that you at the IMF have been warning about,
Yeah.
sovereign,
Yeah.
corporate. Some are wondering if 2019 is the year they start to matter for the markets and investors are going to scrutinize those debt levels more.
I think of debt as a big bag of stones that you carry on your bag. If you are asked to run faster because interest rates are rising, because the financing cost is going to be higher, well, that burden of debt that you carry on your shoulders is going to be more of a drag and will be a deterrent going forward. So is 2019 going to be the year? I don't know, but certainly our policy recommendations is try to limit that growth of debt and move it down in the other direction, make it down, not up, in order to facilitate your response to the shock that will inevitably come.